Welcome back, folks. Today, let's talk about why you probably shouldn't pay down your mortgage as a real estate investor. Let's jump right into it. The first one comes down to the metric known as return on equity. What is ROE and how do we calculate it? Well, ROE is the money you receive after all expenses divided by the total equity you have in the property. This equity might be a combination of your initial down payment, your principal pay down, and any potential market appreciation. When you as a real estate investor buy a property, you typically take out a mortgage to pay for a part of it. The rest would be your own money or equity. In the beginning, since you put in less of your own money, the return on your investment will look better because you would make more profit relative to the amount of money that you have invested. However, as time goes on, you as the investor will continue to make regular mortgage payments, which will reduce the mortgage balance owing and increases your equity in the property, which is further accelerated by potential market appreciation. So when you own more of the property, the return on investment starts to look lower because you're now dividing the profit by a larger amount of your money. In summary, your return on equity is going to drop as you pay down the mortgage and build equity in the property. This decline in ROE is a trade-off for reducing financial leverage and gaining ownership of the property over time. As an investor, you should carefully assess your financial goal, your risk tolerance, and investment strategy to strike the right balance between leveraging borrowed funds and building equity for long-term wealth creation in real estate. The next point that ties into that is the opportunity cost of leaving too much equity in a property. For example, if you had a property worth $500,000 with $200,000 of equity in it, you have 40% equity sitting in it. Now imagine if you refinance this property down to just 20% equity, you'd have $100,000 in your pocket ready to put down on the next property. And this money is also tax-free money because you don't pay taxes unless you sell real estate. Now, of course, how much and how often you want to keep leveraging this money depends on your personal and investing goals. Now, on that subject of taxes, here in Canada where we are, your mortgage interest is tax deductible, which is very advantageous for real estate investors. When you as an investor take out a mortgage to finance your investment property, the interest you pay on the mortgage can be deducted from your taxable income. By deducting this mortgage interest, you can lower your overall taxable income, potentially leading to a reduction in the amount of taxes that you owe. This extra cash can then be reinvested or used to cover other expenses, which will boost your financial position as an investor. So make sure you talk to your accountant about this. That's about it for today's video. If you found this information valuable, don't forget to hit that like button, subscribe to our channel on YouTube, and hit the notification bell for more investing content. Thanks for watching, and until next time, happy investing.